In this video, I'm going to share two outcomes of a market crash. One, to inspire you to get financially educated, and the other is to prepare you for the future, both in being defensive as well as offensive during a market crash. A disclaimer that this is for educational purposes. I'm only sharing my opinion, which I could be wrong, and it is for you to share your thoughts in the comment section below. Now, a quote by Warren Buffett said, "Be fearful when others are greedy, be greedy when others are fearful." This contrarian thinking can help us as we navigate through uncharted financial territories. I'll give you a quick overview of three segments: the past, the present, and the future. A history of the markets, current outlook, and what the future holds. From 1926 till today, the stock market has seen 74% positivity. What does this mean? It simply means that in the next 20 years from today, 15 years will be positive. Only if we do what we have done in the last 95 years at the time of this recording. Let's set some definition so that we are on the same page. A market correction, a bear market, and a crash. A market correction means it dropped around 10%. A bear market is about a 20% drop. And a crash is usually between 35% to 60% drop and typically lasts for 3 to 6 months. Two or more terms you might come across are recession and depression. Now, a recession is when a market declines lasting for 6 months or higher, then we are considered to be in a recession. A depression is when a market declines and lasts for about 2 years or higher, and the GDP of the country drops by 10%. Now let's look at the history of market crashes. May 1946, the duration was about 36 months. S&P returns was about a negative 30%. Recovery period was about 15 months and the GDP declines 1.75. In August 1956, duration was about 15 months. The S&P return was about negative 22. Recovery period was about 11 months. GDP decline about 3.75. Fast forward to maybe 2007. October 2007, the duration was about 17 months. The S&P returns was about negative 57. It was the lowest that it ever went. But recovery was about 65 months. And the GDP declines about 5.5%. Now in February last year, during the crisis, the duration was about 3 months. The S&P return was about negative 34%. Recovery period was about 6 months. And the GDP declined 3.8%. The point that I'm sharing with you is to get the sense of the last decade trends, how long it took to recover, and looking at the GDP, which never did drop below 10%. And that's a critical point that I want you to take note. Let's look at the PE ratio, right? This indicator is something that it is used to value a company that measures its current share price relative to its per share earning. In other words, if a company was currently trading at a PE ratio of 10, the interpretation is that an investor is willing to pay $10 for $1 of the company's current earnings. First up, we have Microsoft with a PE ratio of 33.82. Then we have Facebook with a PE ratio of 27.07. And let's look at Tesla, which is overvalued, and hence this is why people are currently shorting the stock. The PE ratio is 590.92. According to Sheila PE ratio, the median over a 10-year period is 15.83. The minimum was ever, I think, sometime in December 1920, which was 4.78, and the maximum was 44.19, which was in December 1999. So I'm going to leave this with you. Are companies currently overvalued? It is something for you to think about, as you can see what happens after the fall of 9/11, as well as the housing bubble. Now let's look at the federal fund rates, known as the interest rates. We have to, increase these interest rates at some point. The last time, this was actually done was during, Donald Trump. when he increased after Obama. However, due to the recent event that happened last year, the federal government had to stimulate the economy by reducing their interest rate to slightly less than 1%, which was 0.06 in May 2020. Let's look at a simple calculator. What does this mean, right? Or where am I going with this? Imagine a house is at 250,000 with an interest of 1%. You would have paid $1,149 per month for your mortgage. But if the interest rate goes up to 6%, the monthly mortgage rate payment would be $1,704. The issue here is how many people would be able to pay for their mortgage, when the interest rate is going to increase from 1% to 6% or perhaps beyond. Another segment, let's look at the printing of money. Never in the history of the world that the US printed more money. If we print too much money, we may actually devalue the dollar and it would be worthless, as we know in the case of countries that went into hyperinflation. But let's look at the GDP. So GDP was growing steadily, upward, except till the 2020 crisis, which took the world by surprise. As you can see, the recovery was quick. And we are actually in the upward trend. So what can we look forward to the future? Number one, I would say constantly be on the lookout on what the billionaires are doing. Not what they are saying on the media or what the media is trying to present, but what are they actually doing by their actions of buying and selling of the marketplace. I've actually created a video to show how you can actually see Warren Buffett purchasing and selling of companies. Look at the top researchers, firms like one by Cathie on the 5 potential trends for blockchain technology, genome sequencing, robotics, artificial intelligence, and energy storage. Keep 15 to 25% cash, because cash becomes king versus cash is trash during the time of crisis. Another 10% of your portfolio should be in metals like gold. Another 10% into blockchain. Once the bubble pops, the flow of money will change direction, and you should be able to capitalize on selling on the bull run and buying into companies that produces cash flow as opposed to capital gains. Cash flow is the name of the game. So some people are actually saying that this pop is going to happen from June to December 2021. I don't know, but looking at all these indicators, it gives the perception, that the history is going to repeat itself, and for every 10-year cycle, there's always a pop. So what do you think? Let me know in the comment section below. This is Wayne, signing off. Take care.